All right, let's get right into it. Today, we're basically opening up a forensic file, a financial crime scene, really. We're looking at what happened on Friday, January 30th, 2026. Now, the source material we're digging into claims that the silver market didn't just crash. No, it suggests this was a targeted, meticulously planned takedown. So we're going to break down the evidence step by step, just like investigators would.
And I mean, listen to this. This is the core claim right here. The source isn't mincing words. They're calling this the single largest organized robbery in modern financial history. So they're not talking about a market correction, They're talking about a crime scene. And that's exactly the lens we're going to use to look at all the data that follows. So just how bad was it? Well, look at this number, negative 39%. And get this, that happened in just 6 hours of trading. The price of silver just fell off a cliff, going from a high of $121 all the way down to $75. Think about that. In an instant, thousands and thousands of retail margin accounts just gone, wiped out completely. Okay, Section 1, the glitch in the matrix, uncovering the first clue. So, you might be thinking, okay, a crash, maybe it was just a massive panic, right? Well, the analysis we're following says not so fast. It points to this huge anomaly, something they call a glitch in the matrix, and they say it's the very first clue that something was seriously wrong here. Let's dig into the data.
Now, this is where things get really interesting. See, this event completely shattered a market rule that's been solid for decades. For over 50 years, there's been this consistent relationship. Silver mining stocks have about a 2-to-1 downside leverage to the metal. So what does that mean? Simple. If silver drops 10%, you'd expect the miners to drop 20%, maybe even more. It's like a law of physics in this market. So with silver crashing a whopping 39%, you do the math, the miners should have absolutely cratered, down 60, maybe even 80%. But they didn't. They only fell 22%. That just doesn't add up.
And that right there leads to the huge question, the one at the heart of this whole anomaly. Why? Why did the smart money, we're talking the big players, the pension funds, the sovereign wealth funds, why did they refuse to sell their mining stocks when the actual metal was in a total freefall? The source material we're looking at gives a pretty bold answer. They say it's simple. They knew. They knew the price on the screen was a fake, that it was artificial, and that this whole crash was a completely manufactured event. So Section 2, Anatomy of the Trap, deconstructing the 72-hour Killbox. Okay, so if it was manufactured, how? Well, the source lays out this timeline it calls the 72-hour Killbox. It's a 3-day sequence that they claim was basically scripted from the start, designed to systematically trap and just demolish retail traders. Let's walk through how they say this trap was built.
It all starts on Tuesday. That was the bait. The administration drops some hints about a weak dollar policy and bam, silver skyrockets, pulling in tons of leveraged buyers who are chasing the momentum. Then, fast forward to Friday, 6 a.m. The trigger is pulled. Out of nowhere, there's a surprise announcement. A known dollar hawk, Kevin Warsh, is going to be the next Fed chairman. I mean, that's the complete opposite policy signal. But the real knockout punch, the weapon, according to this analysis, that came from the CME group, the exchange itself. They started jacking up margin requirements after the crash was already underway. Not one, but 2 more hikes over the weekend. That's what forced the liquidations.
And that right there is the mechanism they allegedly used, the forced liquidation cascade. Think of it like a death spiral. By suddenly raising the amount of cash you need to hold your position right in the middle of a crash, well, it forces traders' hands. They have to sell at any price just to meet the new rules. And of course, what does that do? It pushes the price down even further, which then triggers even more selling, and on it goes. This wasn't the market finding a fair price. The source says this was a liquidation machine, pure and simple.
Section 3, the smoking gun report, following the money. So you're probably asking, okay, this is a pretty wild theory, but where's the proof? If this really was a coordinated hit, where's the smoking gun? Well, the source we're examining points to one, and they say it's buried deep inside a really boring document, one that's published by the exchange itself.
Here it is, the evidence file, the Exchange Daily Delivery Report, line 661. It's just a single line, tucked away in this dry, technical PDF that almost nobody ever reads. But according to the analysis, this one line details exactly who cashed in on the chaos and exactly how they did it. And just look at this data pulled right from that report. You see a list of major banks, JP Morgan, Morgan Stanley, HSBC, Deutsche Bank. And what were they doing? They were stopping contracts, which is just a fancy way of saying they were closing out their massive short positions. And when did they do it? Look at the timing. At the absolute bottom, at the lows. The source argues that to time this so perfectly, to buy back your shorts at the exact mathematical bottom of a 6-hour crash, that's not luck, that's not skill, that's knowing exactly when that forced liquidation cascade was going to hit its absolute peak.
Okay, Section 4. History's Playbook, a Pattern of Behavior. Now, the analysis goes on to make an even bigger claim, that this event wasn't a one-off. They say that what happened on that Friday was basically a carbon copy of a playbook that's been pulled off the shelf and used twice before in the last 50 years, every time to break the back of a major silver rally.
Exhibit A takes us back to 1980 during the famous Hunt Brothers rally. Silver had gone on this incredible run, from $6 all the way to $50. So what did the exchange do? They introduced something called Silver Rule 7. And this new rule was wild. It literally only allowed traders to sell their positions. You could sell, but you couldn't buy. Imagine playing a poker game where you're only allowed to fold. What happens? The game ends, right? The price just collapsed. They didn't beat the buyers by finding more silver. They beat them by changing the rules of the game.
Then we have Exhibit B, 2011. It's like deja vu. Silver is once again knocking on the door of $50 an ounce, this time during the QE rally. And what happens? The CME Group pulls out the margin weapon again. They raise the margin requirements 5 times in just 9 days. Think about that. That's an 84% increase in the cost just to hold on to your position. And the result? Exactly the same. The price was absolutely crushed.
And that brings us right back to Exhibit C, 2026, the algorithmic washout. According to the source, it's the exact same playbook. You've got a breakout price, you have big players with trap short positions, and boom, a series of sudden margin hikes. The only thing that changed this time, the source says, is the incredible speed. Technology made it faster. What took months to unfold in 1980, and then weeks in 2011, this time it was all compressed and executed in just 6 hours.
Section 5. Paper price versus reality, the physical market seizure. Okay, so that's the story of the paper market, the world of futures contracts and digital numbers on a screen. But the analysis we're digging into argues that the real story, the most critical part of all of this, was happening at the exact same time in the physical world. You know, where actual real silver changes hands.
And look at this. This is a real notice from the Golden State Mint, a major player in the bullion world, not able to secure silver. Now, for a huge operation like this to come out and say it literally can't get its hands on raw material, I mean, that's like Shell or BP putting up a sign that just says, sorry, no gas. It's a massive red flag. It tells you there's a serious systemic failure happening somewhere up the supply chain.
And this is the crazy result. You get what's called a bifurcation of the market. Basically, the market splits in two. The paper market on your screen is screaming $75 an ounce, which signals that there's plenty of silver to go around. But then you go to the physical market, you try to buy an actual coin, and you're going to pay 110, maybe even 150 bucks an ounce. It's like the paper price has become a coupon for a product that's completely sold out, a coupon that nobody, anywhere, will actually honor.
So why is this happening? Well, the source argues that this physical shortage is getting way worse because the big industrial users, they see this paper price crash as a massive clearance sale. Think about it. You can scare a Wall Street trader with a margin hike, but you can't margin call a Tomahawk missile. You can't margin call the green energy transition that needs millions of solar panels. You can't margin call the AI boom that needs silver for circuitry. These guys have inescapable demand. They need the physical metal, and reports say they are backing up the truck to load up at these rock-bottom paper prices.
All right, our final section. What happens next? 2 potential futures. So, where does all this leave us? I mean, with the paper market over here and physical reality way over there, how does this end? The analysis wraps up by laying out 2 very different potential scenarios for what comes next.
Okay, so scenario A is what they call the Soviet store shelf. It's a situation where the official price on the screen stays low, 75 bucks, maybe even lower, but the shelves are totally empty. You just can't buy physical silver, anywhere, at any price. If you want a paper contract, you just get settled in cash. Then there's scenario B, the violent repricing. This is where that stretched out rubber band between the paper and physical markets just snaps. The suppression breaks, and the paper price doesn't just rise, it gaps violently higher to try and meet the physical reality, maybe overnight. And this really brings us to the final, powerful idea from the source material. It flips the whole script on what a bank run is. It says the bank run of 2026 is at the mint, where people are lining up to get rid of their cash. It's not a run on the banks to get cash, It's a run from cash itself into real, tangible assets.
And so, this whole analysis leaves us with one last really provocative question. And this goes way beyond just the silver market, it's this. When you can no longer exchange your currency for actual goods at the official stated price, has your currency already failed? It's a pretty critical thought to chew on.
Thank you for watching. Like and subscribe to see more videos like this, and we'll see you in the next one.